Hello there, welcome to this edition of Global Business Africa from the Kenyan capital, Nairobi. Over the next 30 minutes, we'll have your latest in-depth analysis of the key business stories across Cairo, Johannesburg, Lagos, and the East African capital as well. Wherever you're from, thank you for joining us. Here's what's coming up. We'll be looking at the fallout from the cut ban in the UK, this time from an Ethiopian perspective. We'll also be looking at the better-than-expected flow of gas in new wells in Tanzania. And later on, South Africa is considering turning off the taps on unsecured credit. Let's start tonight in Tanzania, where the BG Group has produced higher than expected flows of gas from an offshore test well, boosting in effect the financial viability of its planned liquefied natural gas export terminal. Now, test flows at BG's Mzia 3 well reached a maximum flow rate of 101 million cubic feet per day. That's nearly double the flow rate measured at Mzia 2 last year. Now, BG, along with Statoil, ExxonMobil and Orphea Energy, plan to build a 2-train LNG export terminal that's expected to be operational sometime in the early 2020s. However, a final investment decision is only set for 2016. Tanzania and Mozambique are locked in a race with Russia, Australia and the United States, as well as Canada, to build LNG export plants. All of these are seeking to exploit a gap in global supply that is expected to open up by the year 2020. Still on more commodity news, Royal Dutch Shell has sold some of its stake in 4 oil fields in Nigeria as it proceeds with a global asset sale in order to cut costs. Last year, Shell put up its 30% stake in each of blocks 18, 24, 25 and 29 in the Niger Delta, as well as a key pipeline, the Nembe Creek trunk line, up for sale. No further details, however, are available on the value of the deal signed or when the sales will be completed. The Financial Times on Wednesday did report, however, that Shell is close to selling the assets for about $5 billion to domestic buyers. France's Total and Italy's Eni are also looking to raise revenue from the sale of their 10% and 5% stake in their assets, respectively. Let's get some more details on this particular deal from Kelly Lemon. She's live in London with us right now. Kelly, Shell is selling assets right across the board, but what's the rationale for getting out of Africa's biggest crude oil producer?
Well, there's a lot of issues, to be honest. Oil theft and security problems have plagued the region for some time. Oil spills are also quite frequent and they've got financial implications, but they've also got legal ones, which is making some companies quite nervous. Then you've got the role of the government, and politics continues to play a big part in the region. There continues to be a lot of uncertainty about the oil bill designed to overhaul the industry, a bill that's sketchy on details and remained stuck in Parliament for 2 years. So there's quite a few reasons really for pulling out of the region.
Indeed. This deal, however, is fairly shrouded in a lot of mystery, however. What more do we really know about the deal? How much, for example, are Shell stakes in the 4 oil fields worth altogether?
Well, as you say, details of the specifics are very thin on the ground. Shell hasn't released the value of the deal signed or when the full process will be completed. However, Shell has confirmed it signed sales and purchase agreements for some of the oil mining leases, but not all of the ones it's looking to divest. And as you say, the FT is saying Shell is selling the assets for about $5 billion to domestic buyers, according to its banking sources. But as you say, a lot of mystery surrounding the actual figures behind it.
Indeed. Finally, Kelly, Shell, of course, isn't the only Western oil firm that is divesting from Nigeria. Eni's pulling out. Total is also cutting their exposure. In the medium term, however, how exactly will this reshape the upstream Nigerian oil sector?
Well, it's certainly increasing pressure to improve the things that we've just mentioned. It appears we will see more players enter the market, with the focus being on domestic buyers. Now, Nigerian is an opportunity, but I'm going to say a lot needs to be done to improve the situation on the ground and attract foreign investment in the long term, and these sales will add to that pressure and very much the picture long term.
Indeed. We'll have to leave it there for the time being. Kelly Lemon, live in London. Let's move back to East Africa. Much like Kenya, Ethiopia is a key producer of the narcotic cat, or Miraa as it's known over here. It's a lucrative business in the country, much like it is in Kenya. Many Ethiopian farmers do depend on the plant for their livelihood. Profits, however, are dwindling, especially after one of the key markets for this commodity, the UK, banned its importation and sale, cutting access to a key market.
Ethiopia's Awade market is the prime area where cat is packed for exportation. Traders, farmers and brokers and other stakeholders meet here to conduct cat business. But the picture is different this time round. A surplus of the plant is evident. This after the United Kingdom banned importation of the plant.
We are in a big problem. Even the guy who brings Miraa from the farm to the market and the guy who also buys here to export.
Cat consists of succulent purple-stemmed leaves and shoots of a bush. Chewing it for hours produces a mild buzz. The United Kingdom classified the plant as a Class C illegal drug and said anyone caught trafficking or supplying will face up to 14 years in prison and an unlimited fine. The World Health Organization says the plant causes irritability, insomnia and lethargy. Other chewers describe a meditative, almost trance-like state where one's sense of time slips away. The user may sit still for hours, yet remain alert to conversation or reading matter. While debates about cat's effect on health go on, around 20 million people across the Horn of Africa and the Arabian Peninsula chew the plant every day.
When you are chewing chat, you read a lot, you focus on what you read. That's why I started chat.
Before I was growing coffee, but it was getting dry. There was not enough water, so I stopped and started growing cat.
The UK was the latest market open in Europe after Netherlands banned the plant. For thousands of farmers and traders here in Awade, the latest ban has already had a severe impact. Previously, the plant was Ethiopia's fourth largest export, earning more than $270 million in 2012-2013. Crops are now sold to neighboring nations, especially Somalia, and across the Red Sea to Yemen. Jean Keo, CCTV.
Food security, that's the latest casualty of the raging Ebola epidemic in West Africa. It's a combination of quarantines, bans, border restrictions and simple outright fear break apart what normally are fairly efficient logistics channels. The African Development Bank is now warning that unless this new emerging problem is nipped in the bud, it will open a new front in a war on an epidemic that is ravaging several economies.
Economic output in Liberia, Sierra Leone and Guinea, which are the worst affected, along with neighboring Ivory Coast, are expected to be hit by the crisis. In fact, in some areas, especially those under quarantine, very little economic activity is able to function freely.
Ebola also threatens economies. This crisis will probably cost 1% or 1.5% of the GDP of countries in the Mano River. Countries that were beginning to recover after difficult years of crisis, the civil wars of the 60s, 80s and 90s. But Ebola also threatens food security because farming in this rainy season hasn't had the required attention.
Mais Ebola aussi met en péril la sécurité alimentaire.
According to the Africa Development Bank, this has not only destabilized the food and agriculture value chain, but is also putting food production at risk, especially in Liberia.
Mais au-delà de la crise immédiate et à moyen terme.
But beyond the immediate crisis and the medium term, the increasing land border closures, as well as precautions taken by airlines in many African countries, may cost a lot in terms of trade and economic flows in general. And this is a continent whose image is at risk, as this is the flow of investment and a renewed stigma, just when the continent was beginning to take off.
Several African countries, though, have made it clear that they are solidly behind those that are bearing the onslaught of the disease and will continue to maintain economic and logistical ties, albeit under tight surveillance.
The core of our foreign policy is Africa-centric. So any country that's hurting in Africa affects us. We want to help, we want to support, we want to encourage, we want to do everything in our power to make the hurting and the feelings of hopelessness and desperation go away. So we're going to engage at the African Union level to support these countries. It could have happened to any country.
The bank estimates that the worst ever Ebola epidemic could cut economic output in the four most affected West African countries by between 1 and 1.5% of gross economic product. Peter Kaba, CCTV.
South Africa's tightening regulations on credit supply. The idea here is to lower the high levels of indebtedness that have put consumers' spending under strain. New affordability assessment laws have now been published for public comment and review. Under these new proposals, credit providers and debt collectors will be registered and they can face expulsion if found guilty of reckless lending. From Johannesburg, South Africa, Sumitra Naidu takes up the story.
According to the National Credit Regulator of South Africa, there are 20.2 million credit-active consumers in the country, a number that has raised concerns, particularly with the Finance Ministry. The Reserve Bank, too, has raised its concerns about growing household indebtedness. Government now wants to change regulations to limit reckless lending.
They now require that every application for credit be properly assessed in terms of requiring proof of income and ensuring that the expenses that are declared by consumers meet minimum norms.
Under the existing National Credit Act, providers use their own models to grant loans, but it was found that consumers did not truthfully declare their expenses. Government wants more stringent regulations around affordability assessments. If those applying for credit can't afford to make their repayments, they should not be granted any loans.
So we've seen cases where a consumer will disclose that they have no, for example, expenses for food and expenses for transport. Now, we believe as the NCR and as the DTI that credit providers should consider at least food, transport and accommodation when a credit provider is assessing a consumer's application for credit.
The National Credit Act came into law back in 2007. The act was meant to limit reckless lending and protect the consumer, but many found ways around the regulations. To date, millions of South Africans are borrowing more money than they can afford to pay back. And sadly, most of that credit is not being used to generate any other income. The regulator found that while people are borrowing extensively to live flashier lives, the majority of South Africans are taking out credit just to survive. 76% of South Africans' disposable income is spent on servicing debt.
What we've seen typically is that on average, secured debt like your mortgages and your cars, they tend to perform much better than your unsecured type of credit.
At least 44% of credit-worthy consumers have impaired records. Earlier this month, we saw the fall of African Bank, one of South Africa's biggest micro-lenders, largely as a result of bad debts. There are fears that this will spread to other parts of the banking and retail sectors.
Given what's happened with African Bank, it's highly likely that that would spread, at least to some degree, in that consumers are already battling across the board. So it's a matter of finding out whether retailers and other credit providers are actually making adequate provision for the bad debts that they are experiencing.
Many South Africans failed to take advantage of the low interest rate environment between 2008 and 2013 because of high indebtedness. Now the country is in a rate hiking cycle. The Reserve Bank has lifted rates by 75 basis points so far this year. With more hikes expected, it's going to get tougher. Sumitra Naidu, CCTV, Johannesburg.
And she joins us now live on the line from Johannesburg. Sumitra, exactly how much unsecured debt is outstanding at the moment between banks and non-bank credit providers?
Well, Rama, looking at the credit regulator's quarterly report in March 2014, the total outstanding debtors book of all consumer credit stood at just over 1.5 trillion rand. That's a 2% increase from the previous quarter. Now, if you look at the report, credit is broken down into a number of categories. There's credit facilities, short-term credit, and developmental credit. If you narrow it down to secured credit, these exclude mortgages. The total amount here outstanding was around 331 billion rand, and unsecured credit stood at 173 billion rand. The report found that while the granting of new credit had decreased in almost all of those categories, the rate at which credit was being repaid also dropped, which is what's causing the increase in the debtors book.
Indeed. Let's look specifically at something that was set up to be dealt with by the National Credit Act. We've seen banks like ABBA lending money to people who are defaulted on other debts elsewhere, which ordinarily should have blacklisted them, prevented them from accessing credit in the first place. So isn't that an indicator that the Credit Reference Bureau aren't quite working as intended by the National Credit Act?
Well, that's right. But from what emerged in the African Bank fiasco, it's become clear that more parties were at fault here. So while the Credit Bureau has a responsibility to ensure that consumer information is credible, updated regularly and readily available, the banks and other finance institutions and retailers too have a responsibility to ensure that all the relevant checks and assessments are carried out. So while the Credit Bureau information is very important, what the regulator is saying here is that other information on the consumer should be part of the process in the granting of credit. Having said that, the regulator also came under fire recently when it proposed to Parliament that all adverse information on consumers with impaired records should be wiped. So this would assist those consumers who have corrected their behavior, so to say, to access credit once again. Their debt wouldn't be cleared, but just the information on them.
Indeed. Finally, Sumitra, what effect is this rate hike cycle having on default rates on unsecured debt?
Well, a rate hike on any credit is never good news. In the case of unsecured credit, it's worse. There are no guarantors or asset security, making that risk on unsecured loans much higher. So for those people who have unsecured loans, they pay a premium. The costs are in some cases 3 times the prime lending rate. We've already had 2 rate hikes, and there's growing expectation that there will be one more at least this year. Already consumers are struggling to pay their existing debt. This just means that they now have to pay a whole lot more, and for those not paying, it means a growing debtors book for the banks and other institutions.
Indeed. Tick-tock, tick-tock goes the debt time bomb. Thank you very much for that. That's CCTV Sumitra Naidu live there in Johannesburg. Let's make a quick run through equity markets here for you. Key issues coming out of Kenya. Earnings from Kakuzi, one of the key agricultural stocks, of course, on the market. Profit before tax down 32% to just over $860,000 in first half of the year. The bulk of that, of course, or the bulk of the decline rather, attributable directly to lower tea prices. Don't expect an interim dividend from there. Rand strength, of course, in the wake of some of the data that we saw from the second quarter GDP data has propped up the Rand. That in turn has affected USD earnings. Miners, of course, did slip today at the JSE, and that dragged the entire index much lower. Coming up next, cocoa has hit a 3-year high. We'll have the details. And McKinsey setting up shop in Nairobi. We'll tell you firsthand what's behind the move. East Africa's region by McKinsey. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies.
From small businesses to large-scale enterprises, hear directly from entrepreneurs behind the story. It's about putting you in the picture so you know where Africa fits in the global context.
Global Business, weekdays at this time on CCTV Africa.
African leaders have been urged to make it easier to move and do business across borders within the African continent.
Africans should be free to move in their continent, to do business, to interact, if we are to grow the levels of investment and trade that will ensure that we are able to create the jobs for our people that we require.
Welcome back. At 1818 GMT, you're watching Global Business Africa. Now, on the 28th of August, McKinsey will be expanding its focus on East Africa, adding to its footprint in 7 African countries at the moment. Now, with a combined population of over 120 million people, annual output in excess of $70 billion, McKinsey officials argue that the region needs to be looked at as something that's greater than the sum of its parts, not just on a country-by-country basis. Earlier today, I spoke to Henrik Awidi, McKinsey's director for Sub-Saharan Africa. Our conversation started by me asking him what makes East Africa an exciting business proposition.
I'm personally, and McKinsey as well, very excited about East Africa as a region. And, you know, of course, it has to do with, if you look at the past 5 years in terms of the economic growth, we have, you know, a couple of countries that is, you know, among the top 10 fastest growing in terms of GDP. But I think even more exciting is, you know, if we look forward and the potential. So we see enormous potential in economic growth for East Africa. And it's driven by a lot of factors, but it's fundamental factors. So we believe that's a fundamental, growth underlying, our excitement. And it goes everything from the infrastructure investments that is planned in East Africa. It's over $100 billion that is going to be spent over the next 10, 15 years. There's the resources, discoveries, there's manufacturing opportunities, there's ICT hub, there's agriculture and so forth. So there's a lot of fundamental things that is happening in East Africa that makes us very, bullish and positive about East Africa.
East Africa as a region, is it better as a block of 5 countries, as an investment proposition, or is it more compelling perhaps and easier for that matter to actually get into one country and then the next and then the next?
Currently, we and most companies is viewing East Africa as a block or a region, and it's a little bit due to the size of the economies and so forth, to get enough scale and so forth. And there's also a lot of integration in terms of infrastructure and economic zones and everything. So I would say, I would view it as an economic block or region.
Mm-hmm. But for the typical viewer who might be looking at this, they'll say, but East African countries between them have a population of 100+ million individuals. You're looking at economies which have a combined GDP of well over $50 billion. So when we say scale, just how big do we need to be for actually to have that strong investment proposition?
No, I think it's a very good point, Rama. And if you compare, the whole region compared to Nigeria is less than half of the GDP. But again, I'm going back to what is the exciting part is the economic growth. So yes, you can say it's, a little bit too early for McKinsey or companies to come in here. But if you look, 10 years, now is the time to be in East Africa, put down your pole in the ground, establish your business to be able to capture the future growth.
Speaking of being first in a particular location, McKinsey has a presence in Ethiopia as well. And Ethiopia, compared to the other East African economies, tends to be a bit of an outlier. A lot more state control of the economy, a far bigger footprint for the state. But you're in there. Why?
We believe Ethiopia is an exciting country. Again, I'm going back, to the historic economical growth, and we're also, very bullish about the economic growth going forward. So it's a country that we see a lot of opportunities and a lot of potential, and we want to be there and we want to help shape the country.
Mm. What's the most exciting opportunities that we should look forward to in Ethiopia?
There is a lot of interesting things going on in the infrastructure. We have the energy project, the rails and so forth, and also both with the economic growth and the population growth, there will be a lot of infrastructure that is required going forward.
Now then, cocoa futures on Wednesday edged up to more than a 3-year high. They've climbed steadily since the start of the year, as we've charted here on Global Business. Speculators are betting on a global deficit in 2014-2015. Cocoa futures touched $3,300 a ton and then lost a little ground to trade at about $32.29 per ton. That was up 0.4%. All the same, prices, however, could go as high as $3,400 by the end of the year, and they will not be falling below $2,800 per ton as growing demand for fine chocolate in China benefits global producers. Here's looking at you, Cote d'Ivoire and Ghana. A 100,000 ton supply deficit is forecast this year, and a shortage is expected of about 800,000 tons or so by 2020 as demand outstrips supply. Commodities now. Let's see exactly what is going on across the board on oil, coffee, cocoa and so on. We already talked about cocoa. Crude oil, however, is still a fairly interesting story in and of itself. Data suggesting that we're seeing low American demand has essentially cut the knees under oil prices down well below $103 a barrel. And of course, that trend looks set to continue. When we come back, we'll be talking to a young Somali entrepreneur about what it takes to run a laundry business in Mogadishu. Welcome back. You're still watching Global Business Africa. Now, after more than 2 decades of turmoil, Somalia is slowly recovering, and that reconstruction effort as a whole is creating plenty of new openings for entrepreneurs. Tonight, let's introduce you to Mohammed Mahmoud Sheikh. He's a man who set up a laundry service that deliberately targets those who require high-end cleaning services not previously available in Mogadishu.
My name is Mohammed Mahmoud Sheikh. I'm originally Somalian. I was born in Italy, raised in Tanzania. I felt like I need to come back here and see what I can do here. So that's the time I came back here, looked at the town and thought like what business to do first. Because I had a lot of ideas, but the dry cleaning idea just popped inside. A normal person who's like, let's say a minister or an MP or a businessman or an NGO worker who wears a suit to work always have to take his suits to Nairobi, Addis or Djibouti for just dry cleaning it. This is our laundry place. This is a place where I do my laundry, like the shirts, the jeans, all the things that need machine wash. The challenges, first finding the location, and I all came to know that this Makkah al-Mukarramah road was the busiest road. Coming from the airport, going to the presidential palace, and every businessman, NGOs, all take this road. It was just really hard for a Somalian to believe like you're dry cleaning. It's like, no, he's using his hands to wash the clothes. So I had to take, to put so much effort on just marketing this business. And now things are going so well. Like I have my business runs from 8 morning until 6 in the evening. Sometimes I run until 9 in the evening. Right now I have customers who always come back like 3 times a week for bringing like 5 suits each time they come. Mogadishu is changing a lot, business is booming. People are now having the confidence that it's peace, So I'm telling my brothers and sisters, Somalians, or anybody, international, foreign people, come to Mogadishu, see for yourself, and I'm sure you can bring some new ideas to the country, because Mogadishu needs new ideas so far.
Now, from reconstruction in Somalia, let's show you an example of what sort of damage a currency's weakness can wreak on an economy as a whole. The producer price inflation data from Ghana out today, frankly, is horrendous. 47.4% year-on-year in July compared to 33.1% in June. Now, considering the fact, of course, that this is essentially a leading indicator, just imagine what the August data will look like as far as CPI is concerned. Remember, that peaked at 15.3% in July. Absolutely disturbing stuff to think about. But still, that of course is a look at the currencies for you. Here's what you can expect, however, on Global Business later on tomorrow. McKinsey, as we mentioned earlier, will be officially launching its East African office. The Kenyan President, Uhuru Muigai Kenyatta, will be there. We'll have the details on that and plenty more. We'll also have a fairly tongue-in-cheek, if you will, look at the potential for tourism in Africa's youngest state. Now that's it for this edition of Global Business Africa. Send your feedback to globalbusinessafrica@cctv.com and wherever you are online. Facebook, Twitter, you name it, we're there. We'll see you online wherever you're watching. Thank you so much for your time this evening. I'm Ramanyan.